Let's look at what's actually happening. Because on paper, this economy shouldn't still be standing. National debt just crossed $36 trillion. That's more than the combined GDP of China, Japan, and Germany, the second, third, and fourth largest economies on Earth. Interest payments alone are burning over $1 trillion a year. Consumer credit card debt is at an all-time high. Corporate bankruptcies are at their highest level since 2010. And yet, unemployment is below 5%. GDP is still positive. The stock market is near record levels. So if the foundation is cracking, why is the building still standing? Because something is holding it up. 3 somethings actually, and every one of them is artificial, temporary, and showing signs of strain. Once you understand what they are, you'll never look at a positive economic headline the same way again. You've probably felt this contradiction yourself. The headlines say the economy is strong, but your bank account tells a different story. Your salary hasn't kept up. Your rent went up again. You're doing everything you were told to do, and it's getting harder, not easier. That gap between the official narrative and your lived experience, that's not in your head. It's real. And the reason it exists is that the economy you see in the data and the economy you live in are being kept apart by 3 mechanisms that most people never learn about. In 2019, total US consumer debt stood at roughly $14 trillion. Today, it's over $17.7 trillion. That's a $3.7 trillion increase in 6 years. To put that in context, it's roughly the entire GDP of Germany added to American household balance sheets in half a decade. Credit card balances alone crossed the 1.2 trillion mark. Auto loans are over 1.6 trillion. Student debt sits at 1.7 trillion. And buy now, pay later transactions, which aren't even captured in most traditional debt statistics, have tripled since 2021. Here's the mechanism most people miss. Consumer spending makes up roughly 70% of the US GDP. When economists report that the economy is growing, what they're largely measuring is people buying things. But the critical question, the one the headline number doesn't answer, is: are they buying with money they earned or money they borrowed? Increasingly, the answer is borrow. There is an economic concept called a credit bridge. It describes the period where consumer borrowing substitutes for real income growth, maintaining spending levels that wages alone can support. The economy keeps moving. GDP stays positive. Retailers report earnings, but underneath, the spending isn't fueled by productivity or prosperity. It's fueled by debt. And credit bridges have a very specific failure mode. They don't collapse gradually. They hold until they don't. Japan learned this in 1989. After a decade of credit-fueled growth, real estate prices in Tokyo that made Manhattan look cheap, stock valuations that defied every fundamental metric, the credit bridge gave way. What followed wasn't a recession. It was what economists now call Japan's lost decade. Except it wasn't 1 decade. It was 3. Japanese stock prices didn't recover their 1989 peak until 2024. 35 years of stagnation because a credit bridge was mistaken for solid ground. The US credit bridge hasn't snapped, but the cables are fraying. Credit card delinquency rates, people who are 90 or more days late on payments, have been climbing steadily since mid-2023. Subprime auto loan defaults are at levels not seen since 2008, and the personal savings rate has fallen below 4%, which means most households have almost no buffer between their current lifestyle and financial crisis. This is directly connected to your financial reality. If you carry any revolving debt right now, you are part of the bridge. And when bridges fall, the people standing on them are the ones who fall. The US federal government spent $6.7 trillion in fiscal year 2024. It collected $4.9 trillion in revenue. The difference, $1.8 trillion, was borrowed. That's not a crisis number. That's a Tuesday. The government has run a deficit every single year since 2001. 24 consecutive years of spending more than it earns, and the gap is widening, not closing. Now, here's what most people don't connect. That $1.8 trillion in deficit spending doesn't just disappear into government bureaucracy. It enters the economy. Federal salaries, military contracts, social security payments, Medicare reimbursements, infrastructure projects, all of that money flows into the real economy. People receive it and spend it. Businesses earn it and hire with it. Strip away the deficit spending and the GDP number you see on the news looks very different. In 2024, nominal GDP was roughly $29 trillion. The deficit was $1.8 trillion. That means roughly 6% of all economic activity was directly funded by borrowed money. Not earned, not produced, borrowed. Economists have a term for this. It's called the fiscal impulse. It measures how much government deficit spending is artificially boosting GDP above what the private economy would produce on its own. And right now, the fiscal impulse is one of the largest peacetime stimulants in American history. Some of you might be thinking, governments have always run deficits. This isn't new. The US has carried debt since its founding. Well, that's true, and in normal times, manageable deficits can be productive. They fund investment, smooth recessions, maintain public services. But here's what that reasoning misses. The debt to GDP ratio, the most widely used measure of how sustainable government debt is, has crossed 120%. The last time it was this high was 1946, immediately after the most expensive war in human history. We're running World War II debt levels during peacetime, and unlike 1946, there is no post-war manufacturing boom waiting to generate the growth needed to pay it down. Hyman Minsky, the economist whose work predicted the 2008 financial crisis decades before it even happened, described a concept he called the stability paradox. The longer a system appears stable, the more risk accumulates underneath, because stability itself encourages the behavior that eventually destroys it. People borrow more because things seem fine. Governments spend more because markets keep buying the debt. Risks compound invisibly until the system is more fragile than at any point in history, precisely when everyone believes it's safest. That's not a theory. That's a description of where we are right now. And it's your purchasing power, your savings, your future that absorbs the consequences when the illusion of stability meets reality. Between January 2023 and late 2025, the S&P 500 gained roughly 50%. American household wealth on paper surged by trillions. Home equity, stock portfolios, retirement accounts, all climbing. Financial media ran headlines about record household net worth. That's real up to a point. But here's the mechanism hiding behind those numbers. There is a well-documented behavioral phenomenon called the wealth effect. It was first formally described by economist Carl Case, one of the Case-Shiller Home Price Index, and it works like this. When people see their assets increasing in value, they feel richer and they spend more. Not because their income went up, not because they sold anything, simply because the number on a screen got bigger. Research from the Federal Reserve estimates that for every dollar of perceived stock market wealth gain, consumer spending increases by roughly 3 to 5 cents. For housing wealth, it's even higher. 5 to 8 cents per dollar. Now, that might sound small, but when household wealth increases by $10 trillion in 2 years, the wealth effect can add $300 to $500 billion in annual spending to the economy. The credit bridge keeps consumer spending beyond their income. The deficit illusion keeps GDP artificially inflated. And the wealth effect mask convinces everyone that the economy is prosperous because their portfolio went up, even though the gains are concentrated among the top 20% of households who own over 90% of all stocks. For the bottom 80%, the wealth effect is mostly a spectator sport. They see the headlines, they hear the market hit a new high, but their wealth is tied to their home, if they own one, and their paycheck, neither of which has kept pace with the cost of actually living. So the economy appears healthy because asset owners feel rich and spend accordingly, because the government is pumping borrowed money into the system, and because consumers are bridging the gap between their income and their lifestyle with that. 3 artificial support systems, each one masking the deterioration underneath. Remove any one of them and the picture changes. Remove 2 and you have a recession. Remove all 3 simultaneously, which is exactly what happens when a credit event triggers a sell-off that collapses the wealth effect while deficit hawks force spending cuts, and you have something much worse. If you just trace that chain in your head, credit stress triggering asset declines, triggering spending cuts, triggering a self-reinforcing contraction, you've just mapped the mechanics of how artificial stability unravels. That puts you ahead of most professional commentators, let alone the average investor. If you've been following this channel, you know we track these cycles in phases. Here's where the economy's artificial stability sits right now. Phase 1. Artificial equilibrium. The 3 support systems are all active. Credit is flowing, government spending is high, asset prices are elevated, headlines are positive. Most people see a functioning economy and assume the foundation is sound. The warning signs exist. Delinquencies rising, deficits widening, concentration of wealth accelerating, but they're in the data, not in the headlines. This phase can last years. It feels like stability. It isn't. Phase 2. Support erosion. One or more of the 3 systems begins to weaken visibly. Maybe credit tightens and consumer spending finally contracts. Maybe a treasury auction goes poorly and deficit spending gets politically curtailed. Maybe a market correction wipes out the wealth effect. The key signal is that the gap between official data and lived experience widens to a point where even mainstream media starts asking questions. Confidence cracks, narratives shift. Phase 3. Cascading withdrawal. Multiple supports fail in sequence. Credit contraction reduces spending, which lowers corporate earnings, which triggers stock declines, which kills the wealth effect, which reduces spending further. The self-reinforcing loop that held everything up becomes the self-reinforcing loop that tears it down. This is where the phrase "it happens slowly then all at once" stops being a literary metaphor and becomes a financial reality. We are in phase 1 with visible phase 2 signals. Credit delinquencies are flashing, market breadth is narrowing, a smaller number of stocks driving a larger share of gains, which is historically one of the most reliable pre-correction indicators. And the deficit trajectory is on a path that the Congressional Budget Office itself has called unsustainable. Phase 1 can last longer than anyone expects. I want to be honest about that. Artificial systems are surprisingly resilient, right up until they're not. But the direction is clear, even if the timing isn't. Knowing the supports exist is the first step. Positioning for what happens when they weaken is the step that actually protects your money. Here's what that looks like in practice. If you're early in your career and building from scratch, your biggest risk right now isn't a market crash. It's being caught on the wrong side of the credit bridge. If you have a credit card debt or buy now pay later balances, you are personally exposed to Force 1. Eliminate revolving consumer debt before you invest a single dollar. I know that's not the exciting advice, it's the advice that keeps you solvent when the bridge buckles. On a $50,000 salary, paying down a $5,000 credit card balance at 24% interest is the equivalent of earning a guaranteed 24% return on your money. No stock in history has offered that with zero risk. If you have a stable income and some savings already in the market, stress test your portfolio against the three forces. Ask yourself, if consumer spending contracts 10%, which of my holdings suffer? If government spending gets cut, which sectors are most exposed? If the market drops 30% and the wealth effect reverses, can I afford to not sell? Build a position in the assets that perform during contraction, not just expansion. Short-term treasuries, dividend-paying companies with low debt, cash reserves that let you buy when others are forced to sell. The goal isn't to predict the timing. It's to be positioned so that timing doesn't matter. If you're approaching or in retirement, the wealth effect is your most dangerous exposure. If your retirement plan assumes your portfolio stays at or near current levels, you're building on the same artificial foundation we just dissected. Run your retirement numbers with a 30% drawdown scenario. Not because I'm predicting that, but because the math should still work if it happens. If your plan breaks at minus 30, you don't have a plan. You have a bet. There's a meaningful difference between the two. Here's the number that puts this in perspective. In March of 2009, the S&P 500 hit its financial crisis bottom at 666 points. The economy was in freefall. Unemployment was spiking toward 10%. Headlines were apocalyptic. Every artificial support that had propped up the pre-crisis economy had been stripped away simultaneously. If you'd put $10,000 into a simple S&P 500 index fund at the bottom, when every instinct, every headline, every person around you was screaming to stay out, that $10,000 would be worth roughly $85,000 today, in 16 years, from the worst economic moment most of us have ever lived through. The people who captured that return weren't fortune tellers. They were people who understood that artificial stability eventually fails, that failure creates opportunity, and that the window to act is smallest precisely when it matters most. I don't know when the current supports give way. Nobody does. And anyone who tells you they do is selling something. But I do know the architecture. And now, so do you. Do one thing this week. Open your portfolio or your bank statement and answer one question. Which of the three artificial supports are you most dependent on? Are you bridging your lifestyle with credit? Is your net worth built on asset prices that depend on the wealth effect? Are you in a job or sector that relies on government deficit spending? Identify your exposure. That's the first step toward not being caught standing on a bridge when the cables snap. Tell me in the comments, which of the three forces are you most exposed to? Credit bridge, deficit illusion, or wealth effect? I read every response. And if this gave you a framework you didn't have before, subscribe. We track these supports every week, and when the phase 2 signal starts accelerating, you'll want the update in real time. None of this is personal financial advice. It's education so you can build your own framework and make decisions that fit your life. Now you see the pattern. The only question is what you do with it.